to the Florida Senior Group here in Chicago, Friday, March 23rd. I'm Killer, and I'm here with the Wolfman. Wolfman, how are you today, bud?
Good, thank you. Glad it's Friday.
Absolutely.
Always a good time down here.
Absolutely. Well, folks, a lot to talk about. It's been a while since we've been able to hit a CMZ together, so it's great to be here on this Friday. But no doubt about it, we are seeing this move in Treasuries. I have been beating my drum, and I kind of been like a lone wolf because last week on CNBC Fast Money, I talked about coming to this 2.28 level. That was the level that was established post-August debt ceiling debacle. We saw the algos run through it up to 2.37 the 10-year, but right now we just took the market back up in the Treasuries, the yield down to 2.21. So for all you naysayers, take that. Treasuries are still here, folks, and I just talked about this morning on Squawk on the Street, and I really think my focus has always been, it's not about a 2% yield, folks. I understand that it's crippling, and when we have a 2% yield, that does hinder growth, no doubt about it, but my strategy, Wolfman, has always been focused on the Fed's balance sheet, and I talked about this and actually rolled it out, but the balance sheet, until they drain those excess reserves, we won't see rates move, and I know a lot of people are seeing the economic data pick up here recently, but no doubt about it, the Fed has come out with a pretty abysmal, that December Fed outlook, so therefore they're going to stay and keep these rates lower, but I think June, it's all about June when this twist expires, so I am calling for a twist on the twist. I dubbed it Operation Pretzel. So what do you think about that, Wolfman?
No, that's a great point. The last thing they want to do is say that they're coming out and doing a QE3, and that's what you mentioned on Fast Money on the Squawk this morning. But it's just because it's got that bad connotation. I mean, really, it's pretty much the same thing. They're still trying to flatten out the yield curve. Like you said, it's going to be hurting banks when they flatten out this yield curve and keep rates low.
Sure.
Now, one thing that I think that they should ask Ben Bernanke is, if they're going to keep rates exceptionally low, what does that mean? I mean, does it mean 25 basis points, which is what the media is kind of playing it up to be? But if it was 1%, that's still historically exceptionally low. For sure. So they could really ratchet this up 25, 50 basis point and still have it as what I would say exceptionally low or accommodatively low.
Certainly.
And you're starting to see that in the Fed funds. We've seen the highest rates we've seen in a couple of years. They've let that rate drift up from like 9%, or 0.09% up to about 15 basis points. That's still extremely low.
For sure, and let me break that into layman's terms, folks, and correct me if I'm wrong, Wolfman, but the Fed funds rate, they are basically betting that the Fed's going to move in 2013 now, not 2014 per Bernanke's statement. But as much as I want to pat myself on the back, and I think I already have, so I will stop. But is this more about the Fed policy, which I believe, or to play both sides of the fence here, is it about the weakening Europe, the China data? What is actually making these markets move? Because we've seen this S&P just continue to go up, up, and up. But right now, we feel like this is a crucial fork in the road.
I agree. I mean, I think we're starting to see a global bit of a slowdown here. I don't even know that the numbers here in the U.S. have been that great. I mean, they've been coming in as expected.
Well, maybe the bar's been lowered so much, Wolfman, that we are seeing better than expected.
That's exactly what I believe. Everybody's talking about great jobless claims. They're really not that great. And having said that, we saw the S&Ps trade up to 1407, tested that a few times. Now we slid back down below. Well, my previous resistance area of 1398 was. We settled below that, slid down into the 1380s. I think the next stop is 1363. That was the previous pivot area. I think we're going to go down there, test that area. We spent a lot of time up here at the 1400s. I think we're going to start seeing a little bit of a pullback. And the Treasuries, like you said, we found support down there. They're starting to confirm a rally here. So I think we're going to see a bit of this tide switching.
Agreed. And let's hit one last thing here, because this is what I continue to try and search for. What is the catalyst to see this S&P relent in the event it will relent? But crude oil, we saw a tremendously volatile session this morning, folks. It was mind-boggling. You saw a $2.5, $3 spike in crude in about a minute and a half. Just a face-ripping situation where it went up to 108.25 and came back off. And it's all due to the geopolitical tension and the Iran supply. How are they going to get oil out of Iran? So right now, is it going to be Europe? The lack of growth, the weakening data, is it going to be China? I personally think it's going to be oil. You get oil to leg up above 110, that's pain locker, or excuse me, that's the hurt locker, folks. And when you see gas, that pain at the pump, go above $5, sweet Jesus, we're in trouble.
I paid $4.68 this morning, so it's right there knocking on the door. And that was before that, what is that, a $3 rally in oil? I mean, and that was, from what I understand, hearing that they're starting to get troops ready to go over into Iran.
It's scary, folks, but if you do want to play this crude oil, the USO, that's an ETF I like, or if you want to play in the Brent, where you see that, you can really play that spread a little bit, but the Brent is BNO, but I prefer the USO, that 40.46, that was the trade I called it on Fast Money, went down to that 39, I was able to buy another unit there, but no doubt about it, we're seeing a wild range, like 41.24 was the high in USO, but from the floor of the CME Group, I'm the killer with the Wolfman. Wolfman, great to be with you as always. And one other thing from the floor, remember, be the hammer.
Not the nail. Take that, take that.